One moment. Okay.
Okay.
One second. Just want
All
to
right.
ping a Discord community as well. Get a few more people hanging out with us. Okay. All right, William, welcome. Glad you're here. All right, those of you watching on YouTube, Twitch, LinkedIn, remember you can use the chat to ask questions or share what you're working on, and Ryan will answer your questions. I'll relay everything to him. And also, if you're sharing anything, great opportunity to see if Ryan has anything that he can point out in regards to best practices or possible risks that you may encounter. All right, Ryan, please introduce yourself.
Thanks, Gary. Thanks for inviting me to do this. Looking forward to it. My name is Ryan Azlein. I'm a corporate transactional lawyer. I'm a partner at a law firm called Stradling, Yoka, Carlson & Routh, which is a full 50-year-old, full service, mid-sized business law firm based in the West Coast. I've been at Stradling for the last 10 or so years and practicing for about 25 years now, and help lead up our emerging company and venture capital group. So that means I work with a lot of emerging companies, which for us means anything from a brand new startup to later stage high growth companies and everything in between, doing their finance work, mergers and acquisitions when those come up, and more importantly, day-to-day corporate and commercial contracts, things like that come up in the day-to-day operations of a business, kind of outside general counsel. And then the other part of my practice is the venture capital. So I also represent venture capital firms, growth equity firms, family offices, other folks that invest in those same type of companies.
Awesome. Definitely appreciate you being here. You've been a longtime mentor and supporter of 805 Startups and now Startmata, what we're doing right now. So yeah, I just, deeply appreciate you. While we wait for some people to post some questions, I want to touch on a couple basic stuff that a lot of early founders, entrepreneurs are often asking about and struggling with. Fundraising, investors. Do a lot of work with them. I think one of the best places to start with that a lot of people might not understand are the differences between an angel investor, a family office, a venture capitalist, a VC fund. Just at the high level, could you kind of explain the differences, and we'll go from there in regards to where those different ones fit in with fundraising?
Yeah, and I guess I would start by saying, there's no sort of strict definitions, and sometimes the lines blurred of what constitutes an investor in those different categories, and sometimes people fit into both, right? So I'll sort of start with venture capital fund, and then talk about how the others compare to that. So what most people talk about when they're thinking of raising a venture financing is raising it from a venture fund. That's typically an actual institutional partnership that's run by one or two or three or a team of general partners who are the ones kind of running the operations, looking at deals, making investment decisions. And then they have a fund they've raised from their limited partners who are their investors, right? Who put money and given it to them to invest in companies. They'll turn around and look for startups that fit sort of whatever their mandate is. And they all focus different industries or different stages of companies. So that's one really important thing to know if you think you're going to go out to raise venture capital and try to figure out who the right investors are. to make sure you know sort of what their focus is, both what stage they like to invest. Sometimes it's geographically focused, definitely industry focused, and also an idea of like how much they typically invest in each round. So all those are important things to know to make sure it's a right fit before kind of what spending time, investing time on trying to reach out and contact people. So those funds are typically, they're typically not investing in a just out of the box, just formed startup. There's exceptions to every rule, right? Of course, especially if you've already had successful startups that you've built and had great exits. They're going to want to work with you from the beginning. But most of the time, they're coming in a little later where maybe you've already raised a little bit of friends and family or angel money, which we'll talk about in a minute. And you already have kind of a product market fit, at least, if not already some kind of revenue traction and things like that. So that's start with venture capital fund, if that makes sense.
No, absolutely. And it's definitely appreciated, like hearing those distinctions. And like a lot of people, because they conflate them, they approach them all the same. And so it's good for you to kind of call attention to that, how they are different, especially with the VCs when they're raising funds from other investors to fund the fund, right? And they also have those investment theses, which are going to dictate how they invest and what they invest. Building on that, so there's more recently, because of Y Combinator, been a lot of popularity with SAFE as being an investment structure for startups and investors to work with, which is an alternative to convertible notes. But I'd love to hear from you from a legal perspective. What are the differences between these different types of contracts that are being utilized, and what are the pros and cons for founders and investors, again, from like a legal standpoint?
Sure. So I think if you're raising money in a financing transaction as a startup company, as you just said, there's a few different structures you can use to raise the money. One would be an actual equity investment, meaning the investors are buying shares of stock in your company at a set price. And typically that's preferred stock, which means they get some preferential rights that common stock that's held by founders and employees and other original members of the team don't have. And the primary one of that would be a liquidation preference, meaning they get their investment amount back first in any kind of liquidation scenario, so they have some protection on the money that went in. And so the key thing with that, actually selling equity in what's called a price round, is there's a set fixed price. So you figure out sort of what the value of your company is. Simple example, if you're going out and raising $1 million, and you agree that the post money, meaning after the money comes in, value of your company is going to be 5 million. That investor who's putting in $1 million is going to end up owning 20% of your company, right? 1 million out of the total 5 million value. And the advantages of doing a fixed price round is that you know exactly what everyone's ownership is, and you've kind of set that in stone more or less, and you move forward from there. And there's more clarity. The downsides are it's a little more, well, a couple of things. One, from a business standpoint, you've got to agree what that valuation is, which is not always easy to do, especially in the very early stages. And then on the kind of the legal side, there's a little more process and documentation and paperwork involved with creating the stock that you're issuing and doing all that. So it's a little higher cost compared to the alternatives. So the alternatives are what you mentioned, some sort of convertible security, a convertible note, or a safe. Safes have been around a long time now and are widely accepted, but before they became widely accepted, people most often did convertible notes as an alternative to a priced round. So a convertible note or a safe kind of work the same way, which is the investors giving money to the company. They're not actually getting shares of stock in the company. What they're getting is an agreement to get shares in the future at some price that's going to be determined in the future. And that price is determined usually, in most cases, has a cap or a maximum price that those investors are going to pay, and that's the valuation cap. Um, and sometimes can also have a discount associated with it, which means that at worst case, they're going to convert at a discount to whatever the valuation is in that next round that converts it. The advantages of doing that are, yes, you don't necessarily have to agree 100% on the valuation, but in most cases that's mitigated a little bit because you still have a valuation cap. So there is still going to be some discussion and have to agree on what the valuation cap is. But there's far less actual terms and conditions to negotiate and document because that's for the most part deferred until the next round when you do a price round and these all convert into stock. That's kind of the advantages and disadvantages. The SAFE was created. SAFE, SAFE stands for Simple Agreement for Future Equity, as kind of an alternative to the convertible note for a couple of reasons. One is if people that did convertible notes historically, while it's meant to turn into an equity investment, and for the most part, everyone expects that it's going to convert into equity, it was still sort of structured as a note or debt, meaning that at some point in time it would become due. So if the company never raised that financing round, they would have a loan that comes due and theoretically have to pay that amount when it's due if they could. And then typically would also have an interest rate associated with it, just like any other loan that would be accruing and either convert into shares or have to be paid. So the SAFE kind of simplifies that. It actually in most cases does not have a maturity date. So it just stays outstanding as a SAFE until there is a conversion event or the company shuts down basically. And there's no interest rate tied to it again, typically. And then the other thing about the SAFE in particular, and this was driven by Y Combinator, there was a few different kind of alternative structures that were very similar that people were using. But Y Combinator decided to say, all right, here's a standardized version that we're going to publish to the public with the idea that everyone will use this and it will reduce the amount of legal costs and the friction. And all you have to agree is there a valuation cap? If so, what is it? Plug that into our standardized form. Is there a discount to the conversion? If so, what is it? Plug it into our standardized form. And for the most part, everything else is standard. And that actually works. So I would say, not every case, certainly. There's always negotiated points, but definitely a majority of the SAFE financing transactions we work on, people primarily stick to the Y Combinator form. And it, again, just simplifies, speeds up the process of actually getting money in the door.
Awesome. That's an amazing breakdown. So yeah, I hope everyone's learning from you. Arlo asked, raising pre-seed and very grateful for this, Ryan and Gary. Can you talk about best practices for setting terms when raising with a post-money SAFE?
Yeah. So yeah, it's just following up and kind of exactly what we were talking about. So if you're raising your pre-seed or kind of your initial funding for your company and doing it on a SAFE, that would be pretty typical to have a post-money valuation cap. So that's kind of the negotiating point, the business point that you have to agree on. From a best practices standpoint, from the company's standpoint, certainly, I would try to stick otherwise to the Y Combinator, standard form SAFE, so that you're not having to negotiate a bunch of other provisions. And negotiate the valuation cap. Otherwise, stick to the standard form SAFE as much as you can.
Hopefully that helps. If you have follow-up questions, please post them. That goes for everyone else that's joining in, some newcomers. If you have questions, please ask. If you've just simply working on something or you want to start something, it's awesome to hear about that. And then again, Ryan can chime in and share any experiences or possible risks that might be ahead of you, so you can be aware and take the right precautions to address those appropriately. On that note, while we wait for some more questions, Ryan, what are some recent mistakes you've seen founders make that you have helped address, help fix, and what did the cost look like in regards to them doing things the right way before it became a problem versus having to go and fix the problem after it became a big mess?
Yeah, and this kind of, I think, ties also into the best practices question that came up before, right? So what I would say is it can be tempting, especially if you're doing something like raising money on a safe, to say, oh, it's a standard form that Y Combinator, I can pull off their website and plug it in and give it to the investor, have them sign it, and we're off to the races and just do it myself. Could you do that? Yes, but only if you truly understand what all is in the document and make sure you're filling it out correctly. What I would say is you should at least you should have a lawyer involved, and if you're doing a safe financing and sticking to the standard form, they shouldn't actually have to do much work, but you want them at least to answer questions for you. Make sure if you're taking it on yourself to kind of fill out the documents that they eyeball them and make sure you're doing it correctly. So just to give an example of where that can bite you, which might seem really simple, but actually was not, is as I mentioned, sometimes a safe will have a discount on their conversion price. So in other words, like a 20% discount wouldn't be unusual. And what that means is that it's going to convert when the safe converts, meaning when you raise a price round in 6 or 12 months or whenever it is, and the safe's converting, it's going to convert at a 20% discount to whatever the price in that new round that the new investors are paying. So the way it's drafted in the Y Combinator safe when that happens is not always intuitive. So I had a client that we came in after they had issued safes and we were helping them with the priced equity round, and they had actually done the numbers incorrectly, so that when they really meant to say there's a 20% discount, they ended up giving the investors an 80% discount, which would completely mess up your cap table. So we were able to fix it, and it was an honest mistake in that case, but it could have been a real issue if the investors were not sort of friendly and willing to acknowledge the mistake there. So that's just one example. The other, aside from just getting filling in the documents wrong and not preparing them properly, when you're raising money on safe rounds, a sort of, I don't know if I call it a mistake, but something you got to be really careful about is raising a bunch of money on safes, especially with multiple different terms, before you do a price round that forces everything to convert. So there's a couple reasons why that can be problematic. At a minimum, it can make it really sort of complicated to do the next round if you have 20 different safes converting on 5 or 6 or 8 different prices and terms, and raise the cost for doing that. But it also, because of that complication, makes it difficult to understand for the founders how much equity they're actually giving up to people when they're taking them in. So make sure that's the equity as a founder that you're giving to investors for their money is the most valuable thing you have, assuming you believe your company is going to be successful, which hopefully you all do. So you got to be careful with that, and at a minimum, understand exactly it is what it is that you're actually agreeing to, and model that out. And it gets really messy and complicated, like I said, if you just keep doing more and more safes.
Appreciate that, especially the little examples and everything. We got some more questions. So Doylan asks, hi guys, thank you both for these office hours. They're always really insightful. Glad you're appreciating them and enjoying them. My question is, what does the mindset and process look like when it comes to initially thinking you want to raise some money? Let's say you have an MVP and pre-revenue and are pre-revenue. Would this be under consideration, or is more ideation needed and stability for it to be something worth raising funds for? So yeah, essentially, at what point and how do you approach fundraising, and what validation and leverage should you have is what I'm reading from this.
Yeah. So, I mean, a couple ways to answer that. One is that just in general, right? The further along you can get, the more kind of milestones you've hit or proof points that you can show to investors, the better off you're going to be. Um, that's just high level, and I can talk to that a little bit. But it also kind of circles back to the original question that Gary asked about different investors. So it depends who you're going out to try to get money from. So, when you're just starting the company, it sounds like you are. In this case, there's already an MVP, but maybe no customers. It's going to be more of a challenge to get investors to put in money if you don't have revenue, or at least have some reference customers or something that shows that there's a product market fit and something that's going to be repeatable. So the more you can go down that road, the better. If you can do it with kind of bootstrapping yourself, that's great. The next sort of alternative up the ladder is you may have heard of friends and family rounds. So if you know people that know you and are willing to put in a little bit of money to get you to that next kind of milestone or next proof point, that are really more investing in you because they believe in you and what you're doing, that can be a useful way to take a little bit of money to be able to prove something and be in a better position than to go out to more sort of professional investors. Gary had mentioned in the initial question today about angel investors, so that's kind of in between. Traditionally an angel investor are typically like high net worth individuals that look for early stage startups and get in early, invest some capital. Ideally, they also have some great expertise or connections, so can help you also position yourself to go raise your next round from more kind of professional institutional investors. But again, and if you get to the point of raising money from VCs, they're going to have different stages they invest in. They're going to have different, thought processes on what specifically their requirements are for an investment. So it may be a certain amount of revenue that you have to hit. It may be, just like I said, a product market fit. It may be at least some kind of customer reference that they can check out, or some growth rate if you're a little further along. But you kind of have to talk to them or talk to people who know them to figure out what their metrics are going to be.
Excellent. Vivek asks, this is fun because we're flipping it. Hi Ryan,
All right.
thanks for your insights. I'm working on launching my VC fund next year. Any tips on A, how I should go about it? B, what's the best way to reach out to investors and get them to invest? This is a fun one.
Yeah, so that's a pretty open-ended question, right? So if this is a first VC fund, that's going to be the hardest part, is getting investors to commit to it. The most effective way to do that typically, well, a couple different ways that I've seen effective. So one would be if you have some connection to some particular community of potential investors. So that might be in a specific industry or space that you've been in. It might be if you're focused on one particular type of product and people in that space, and you have great experience and connection to them. That might be a way to get intros to people and get them to invest. For most funds, the only way to really get momentum and get people going is to have an anchor investor, right? So what that means, or more than one anchor investor. So what that means is get, an initial investor or group of investors that are going to put in a significant amount of money, and kind of get things moving. And investors in funds are just like investors in companies, right? A lot of times they don't want to be the first one, but as soon as there's other people that are involved in pulling the trigger and wanting to do it, then it makes it a lot easier for them to say yes. So those are just a couple of generic kind of ideas on how to get started.
Um, it came up a couple times when we were talking about it from the fundraising side, but do you have any like suggestions for resources or basic best practices for putting together an investment thesis when you're going to go raise your own fund?
Yeah, I mean, I think, I think the more focused, I guess, you can be, probably the better. And I think you're going to have to demonstrate that you know what you're looking for, and the investor has confidence that you're going to be able to find those kind of companies. So it's both, you have expertise in whatever that area is and that stage of company, and how you're going to add value to the company when you invest, other than just putting in money. And also on the other side, part that goes side by side with that is, how are you going to get high value deal flow and get into those deals and see those deals. So again, that could be because of relationships you have in the space. That could be because of relationships you have with other investors that are going to show you deals. But whatever you can do to give confidence that you're going to see the right deals, and then be able to win those deals because of what you can bring to the company, and then actually help those companies become more valuable.
It's interesting because, like, how you're describing to formulate the investment thesis in regards to being very focused and being able to speak to those very clear points of experience or expertise, and that knowledge base that's relevant. It goes the same way in regards to fundraising for your startup, when
Right.
you're putting the pitch deck, right? When you're trying to sell them on your company, and the fact that you know the market, you're able to provide a product that's enjoyable, beneficial, and valuable to that market, and show that you have some validation behind those assumptions that you formulated. So it's really interesting how, a lot of these same concepts, they or methodologies, if you will, are very much the same. They're just, slightly different contexts and how you apply them. So it's really fun to hear.
Yeah, and you kind of hit on it, but really, in both cases, whether you're raising a fund and trying to get investors, or you have a startup and you're trying to get investors to invest in your startup, really a huge part of what they're investing in is the team. Um, and that's great. You might have great plans if you're raising your first VC fund on how you're going to do it and how you're going to make money and why you're going to do it better than the 10 people down the street. Um, and you may have a great pitch deck if you're a startup raising money for this great new technology or product or whatever it is. But really, what those investors are investing in and what's going to make the difference is the team and how well they're able to execute on it. So I think that's, however you can play that up in any sort of presentations, and show the strengths and make sure you fill out any weaknesses, is super helpful.
So you see a lot of pitch decks. You help investors, you help founders on both sides. And we're kind of like, already touched on this a little bit, but what are some of what are some elements that you've seen with pitch decks that make them most effective? And what sort of feedback advice can you give to founders in regards to putting together an effective pitch deck, but also a presentation?
Yeah. Yeah. I mean, we could do a whole hour talking about pitch decks. But I think just a couple quick takeaways. There's a few things that people expect to see in a pitch deck, but to me, like, the most important thing is drawing people in and getting their attention right away. So, and there's a couple different ways to do that. I mean, typically it's starting out with explaining why there's a big problem, which is the opportunity for your business, and how your solution solves that problem. And, that can be done through different ways, whether it's, sort of, what is the pain, right? Is there a personal story? Do you have personal experience in it that you can show? Is there, something amazing to draw them in at the beginning and get their attention? When you're creating the pitch deck, you don't want to have too much information in the deck, right? What you want to get is people interested in asking questions, have follow-up questions for you, want to learn more. So I think overall that should kind of be the goal. pique people's interest, get them interested, and have them follow up. That said, like I said, you always got to start out with sort of what is the problem / opportunity that you're addressing? How are you going to do it? Why you have a competitive advantage, whether so that's some sort of comparison to your competitors. Um, Highlight the team, especially if you have strengths there, as we talked about before. Those are kind of key things that people would always expect to see in your deck, in addition to some explanation of exactly what the product is, your solution is.
Sorry, my camera decided to cut out for some reason. But yeah, no, yeah, again, fantastic insights for everyone to learn from, and hopefully, yeah, hone in on, again, we say this all the time when we're doing these office hours and pitches come up. It's a persuasive story, and you need to tell a compelling story, and it's about how you first started, like you're saying. So it builds on what that introduction is and continuously adds more. And again, as you pointed out, it's so important not to get too into the weeds and too detailed and overwhelm people with a bunch of these little, like, nuances that don't really matter yet, because
Right.
they still, like, they haven't yet gotten an understanding of what the heck you're talking about, who the, like, the key characters are, what the plot line is, and you're trying to go off on all these crazy tangents that mean nothing to them yet. So really good insights. Real quick, we're going to jump back to Vivek because they added a little bit more context. Vivek adds, thanks, Ryan. My investment thesis is in healthcare. I have a deal flow. Would it be easier to raise funds from LPs or HNWs since I've got deal flow covered? And Ryan, I would love for you to define what those acronyms are for everyone.
Sure. So good question. So LPs stands for limited partners. That's more of a legal term. So in a fund, it's typically a partnership that has two types of partners in their fund structure. One are general partners, as I mentioned earlier, kind of the management team who's running the fund, and then limited partners who are providing the money, right? So they're have less sort of input, if any, on how the fund's operating, but they're putting in their money and based on whatever the terms are, whatever investment return terms. HNWs, I'm assuming, is what Vivek is referring to, high net worth individuals. So I think Vivek's question is more about raising, if I got this right, and feel free to add to your comments in there if I don't. But should you try to raise money from high net worth individuals, so people who are individual accredited investors and typically invest in funds, or from more kind of institutional limited partners, which could be, corporations that invest, it could be sort of family offices, could be, bigger VC funds get a lot of their money from pension plans, state pension plans, and other pension plans, things like that. So there's a wide variety of types of LPs. I think it's going to depend on how much you're looking to raise, how big's your fund. There's legal and regulatory concerns about how many investors you can have in your fund before you get into a sort of more strict regulatory regime. So you want to talk to your fund lawyer about that and make sure that you're structuring it properly. But I would say, if you're raising a on the smaller side, $10-20 million fund, and you have access and ways to get in touch with high net worth individuals that would be able to supply that capital, that could be a good way to go. Obviously, if you're raising $100, $200, $500 million fund, you're going to need bigger check amounts just to fill that out. So I think by definition, you're going to have to go to some more kind of institutional investors.
Awesome. Doylan asks, I'm pretty unfamiliar with raising funds as a whole. So as a high level explanation, so a high level explanation would be great. And I know this is quite varied case by case, but after having raising funds, what is the typical usage of said funds? Do people pour into advertisement and of course maintenance of whatever the service is, but how much stays liquid, etc.? And building on this again from your legal expertise perspective, it would be also really beneficial to hear what legalities are involved in regards to the use of funds or the management of those funds?
Yeah, sure. So a couple things. I would say just sort of to the question specifically, which is kind of a general question. Obviously, it depends on what the business is and how you're going to use that funds, what stage you are. But all that should be part of what you think about and develop before you go ask investors for money, right? So um, you want to be thoughtful for yourself, but you're also going to need to demonstrate to those investors, how much money do I actually need? What do I need it for? And what am I going to achieve with that money? Um, you know, there's different types of companies, so it's not a one size fits all. If you think of like the traditional kind of venture backed company that's planning to, their expectation is they're going to grow fast, raise multiple rounds of money, and then have some exit, whether that's a sale to someone else or an IPO eventually. That's going to be very different than you have kind of a more closely held kind of, you know, founder owned business where you're looking to raise some money to operate, to get profitable and just keep chugging along. In the first scenario, right, venture backed company, you're going to go and present to your potential investors and say, I need $3 million and here's what I plan to use it for. This much for develop research and development, this much for sales and marketing, this much to hire new team members, whatever it is. And they're going to want to know just as, if not more importantly, how long that money is going to last you, right? Is it going to last you 12 months, 24 months? Do you think it might actually get you to be a profitable company? Because they're thinking ahead. I'm going to invest now and own this percent of the company. And if this is a fast growth venture backed company that's on that trajectory, I'm as an investor also expecting them to raise more money. So I'm already thinking ahead. When is that going to be? How much is that going to dilute me? Maybe I'll be able to put in more money. Maybe I won't, depending on what kind of investor I am. But again, all that kind of use of funds should be thought through. And, to go back to your pitch deck, oftentimes that's in the pitch deck. Like, we're looking to raise $3 million. Here's what we're going to use it for. It doesn't mean you're strictly stuck to using it for those specific purposes and in those amounts, but it's to show that you've thought through it in kind of a general idea. Most of the time in venture type investments, there's not strict regulations on how you use the money, with a couple of exceptions. So there might be a general kind of use of proceeds that you're going to use the money for, general working capital, grow the business, and limitation. What there often will be are limitations on using it for any type of distributions of cash to shareholders or loans or paying back founders. There's often limitations on that. The investors want to know that the money they're putting in is going to grow the business and make it more valuable. But it's most of the time not strictly limited to, advertising, marketing, hiring, etc. In that way, if that makes sense.
No, yeah, definitely. This touches on a couple like elements as well. Um, so, what are some legal mistakes you've seen people make when they're putting together a pitch deck, giving a presentation that is a big no-no that they, could possibly move into the realm of fraud or just, create some other sort of legal risk?
Yeah, I mean, the biggest thing is just being honest, right? So not overstating, not misrepresenting things. So where that can often come up is people, maybe people often have a slide of here's who our customers are with a bunch of logos, right? Don't put people on that slide if you don't actually have a relationship with them. That's something that people sometimes will want to push the boundaries for. Like, we've been talking to them, they said they're going to buy from us or use our service. But if they haven't actually done it, don't present it as that's actually a customer. Same thing. If you're showing financial results, not projections, right? Projections are what you think you're going to do in the future, and everyone kind of knows those aren't going to be right. They're going to be wrong one way or another. But if you're showing like, here's our revenue or what our revenue run rate is for the last or 12 months or what it is right now, again, don't just misrepresent that. That's got to be based in reality. I've been on kind of investor representation side where those things have come up, and it becomes a huge issue for both the company and the investor. So that might be kind of obvious, but don't overstate. You're a startup founder, so you're trying to be aggressive and push boundaries and all that. But there's actually is a line where you don't want to just actually misrepresent things. And just to go back to the customers, many investors will want to verify those customer relationships, and oftentimes they'll do that by getting a contact through the company. But sometimes they might have their own independent relationships by chance and reach out and find out that the story is not what the founder explained it to be. And once you lose credibility, that's, you're not getting money from that investor or any of that investor's friends, right?
So something else came up earlier that I love your opinion on, or at least thoughts. Someone was making posts in my Discord community asking for people to invest in their company. And I'm curious, and I know this depends from territory to territory, but in the US, right, what are the limitations or, again, legal risk in public solicitation for funding?
Yeah. No, that's a great question that comes up and is not always understood. So it can get a little technical. So the first thing is have a lawyer that works with you and make sure you talk to them before doing anything like that, because if you do something that's going to violate the securities laws, it might create problems with you raising a round, or afterwards cost you a lot of money and force you to have to give investors money back. But to answer your question, so the way the U.S. securities laws work, and again, it can be complicated because each state also has its own securities laws, but for purposes of this discussion, assume there's kind of they follow the U.S. securities laws, which they do for the most part. You have to sell any securities, right? You either have to register the securities, which essentially means doing an IPO, or you have to have some exemption from registering those securities with the SEC. So what's relied on for almost all fundraising of the type we're talking about, right, is doing some sort of private placement. So it's a private placement exemption, and that's the name of it. And it's because you're not doing a general solicitation or offering to the public. There's a couple different ways to structure it to make sure you're complying. Regulation D is one of the regulations under the SEC that allows you to do private placements. And again, there's different options you can fall under. For the most part, you want to make sure you're selling only to accredited investors, which have either, a minimum income threshold or net worth threshold if they're individuals, or satisfy other requirements if they're entities. And you want to make sure that you're not, unless you're specifically structuring it with the help of a lawyer, you want to make sure you're not engaging in any, what the SEC calls general solicitation. So that means advertising to the public saying, hey, I'm raising money, I'm trying to get investors. If you do that, then you've probably blown the Regulation D exemption. And, you won't be able to close a financing that's in compliance with laws, or if it comes up later, your investors may have rescission rights, which means they have a right to get their money back. You could be subject to other kind of penalties from the SEC. Now, there is a part of Regulation D that allows you to do general solicitations to raise money, but it requires some extra work that you ultimately raise money from only accredited investors, and that you've taken steps to verify that they're accredited, not just signing a document, but there's more steps involved to that. Either a third party does it, or they've invested such a high amount that they have to be accredited. You know, I'm happy to talk to anyone about the specifics of that. And there's also specific requirements to doing that type of a public solicitation offering, including filing a Form D with the SEC before you start. So again, you want to make sure you're kind of talking to a lawyer if you're thinking of putting anything out to the public. There could be, you know, your example, if that's a closed community, again, you can talk to a lawyer and figure it out. It's not always black and white, so there could be gray areas, right? So if it's a closed community of people that you're posting it to, and those are people that you either have a personal or business relationship with, or you reasonably think they would all be accredited investors, then it might be okay to post it there. But if you're throwing something on LinkedIn or sending out, you know, message blasts to the world, that's going to be definitely a general solicitation. It could be problematic.
Appreciate all the insights and context. And I think, you know, another theme that's often coming up with all these wonderful office hours is context. Context is the key to everything. And that's why it's so important to not try doing this yourself, not use ChatGPT, not use these template forms yourself, but to sit down with a lawyer and make sure the context is correct. And they're the ones that are going to be able to give you the correct prompts to get the right information to contextualize what's going on. Another thing that came up earlier was, I mean, this comes up every day, but a founder was trying to write their own privacy policy. Again, I'd love to hear, like, you know, your thoughts on the messes that you've seen result from that, and the cost differences between using a lawyer to do it right the first, you know, from the beginning, versus cleaning up the mess that happens.
Yeah, sure. No, that's a great example. So privacy policy, you know, everyone putting up a website, if you're operating in California, with some very limited exceptions, are supposed to have a privacy policy on your website if you're collecting any information. So any personal information from the general public. So that's just for California and some other states a legal requirement. They don't dictate exactly what you have to have in it, but privacy policies, privacy in general, right, is an area where there actually is liability out there. If you not only need to have a privacy policy, but you need to know exactly what's in there and make sure you're following it. Most importantly. So just copying and pasting a privacy policy off another company's website is not going to do the trick, because you need to make sure it actually reflects the way you're operating. If not, then you know, there are plenty of class action lawyers out there who are running around looking for people to file claims against for things like, you know, not following your privacy policy, breaching the privacy regulations. Other examples are websites are also supposed to be ADA compliant in many ways. So if that's another area where there are these lawyers that are filing kind of class action lawsuits against companies. And if you're a small early stage company, you know, it's no fun. They may not even have a real claim, but you still got to find a lawyer to deal with them and answer them. And what they're looking for is some sort of at least nominal settlement to go away. So it's probably going to cost you, you know, some not insignificant amount of money just to deal with it, whether that's 10 or 20 or could be more depending on the size of your company. So I would say, you know, that's one of those things that's unfortunately you don't want to take lightly. And like I said, again, you know, it happens all the time where look for a similar company, find their privacy policy and try to just copy and paste it. But that's definitely an example of an area where there is real liability potential there. And it makes sense to talk to an expert and have them, you know, spend a little bit of money up front to get it done correctly, so that you're saving money in the long run, right? It's just another area where a lot of these things can a little bit of investment up front will save you a lot down the road.
I want to ask another follow up question that's related to this that I see happen a lot. Um, Founders, they go to these different forums and ask for legal advice, and they are crowdsourcing information from people that aren't lawyers. And then similarly, again, they're using like Chat GPT or something, equivalent to figure out again legal advice. How much of a or how much time and money does that typically end up costing a client that comes to you that gathers all this misinformation or erroneous information and dumps that on your plate while trying to get you to engage with them to like write a contract or put together some term sheet or something like that? Like, is that like a common thing that costs them money, or is it like a no big deal?
Yeah, it's gonna depend, but I think it's a great question to bring up, especially it's coming up more and more like almost every day, right? Is use of AI to get answers to questions, but even like, we're I see on a maybe not daily basis, but at least a couple times a week, a client or someone, a potential client or somebody will send me, oh, I had AI draft this agreement. Tell me what you think, right? And on the one hand, there's really helpful tools, and they can be really helpful in a lot of ways. Um, on strictly on the legal side, especially unless they're like special purpose legal tools, which mostly law firms are using, they're not quite there yet. So you might get lucky. I've gotten some of those documents that a client's generated. If they're pretty simple, straightforward agreement, um, I've gotten some of those that a client's generated through AI and wanted me to take a look at, and I was pleasantly surprised. Like, this is actually pretty good. I might change a couple things here or there. And then I've gotten some which were just completely useless. And to your point about a cost and time savings, if there's some document you need, a non-disclosure agreement, for example, right? You're talking to a potential customer or business or strategic partner or something, and you want to sign an NDA, non-disclosure agreement. Yeah, you could go onto ChatGPT or one of the other AIs and have them generate one, and it might be okay. Might not. It's sort of unreliable, but that's something where you could come to us or any other good lawyer and say, I need this, and we have vetted forms that we're very comfortable with, keep up on the latest legal developments and make sure they're updated, and can provide you, and would take 10 minutes of my time, right? So rather than review something that's been generated and revise it, it's going to take 3 times longer than just say, come to us first and say, hey, do you have something that works here? Yeah, no problem. Here you go. Let me make sure it works for your deal, and you're off to the races. So yeah, I think it will get there, and there will be great resources to use AI to generate contracts and things like that. I'm 100% sure of it, but most of it's not quite there yet to be used reliably.
Appreciate that insight. Doylan asks, is there any niche advice tips that you feel you do not hear talked about often in regarding to funding and legal space when it comes to SaaS tech startups services space?
Sure. So SaaS specifically. So yeah, I mean that's a space where for sure there are investors, particularly in our area here in Southern California, that are, if not exclusively, almost exclusively focused on doing SaaS investments, right? So that's an area where you should be able to pinpoint, if you're going to raise money, the exact kind of investors that would be interested in your type of company. It's also, it can vary. I mean, SaaS is still pretty broad. There's all kinds of different services and products and revenue models, right? Pricing models. But it's also a space where there's some pretty widely accepted metrics that you can research and find and see how you match up against those metrics that investors would be looking for to drive to, whether that's, lifetime values, conversion prices, things like that.
Putting out a last call for questions. See if there's any follow-ups, but while we wait for that real quick, we've talked about the need or importance of using a lawyer for legal things. You've been an amazing contributor to the local community. You are very active in different events and different programs, mentoring, sponsoring, just again being an incredible resource. For those that are struggling with finances, especially in the early stage, especially those that are, just beginning their entrepreneurial career, what advice do you have in regards to being able to find a lawyer and work with a lawyer when those finances aren't quite there yet?
Yeah, sure. So I guess just what I would say generally is whatever type of company you have or whatever you're doing or whatever issues you have, if you think you need a lawyer, know you need a lawyer, whatever it is, find one that actually fits your need, right? And so that kind of ties into your question. So my practice is built on working with startups and early stage companies. As you said, Gary, we don't just sit in our office and look at agreements. Like I want to get involved and build relationships from people at the earliest stages, right? So that means we're also spending time to do whatever we can to help, whether that's being flexible on fees and fee arrangements for brand new startups, whether that's seeing what we can do to help them, introducing them to other potential advisors or even investors in some cases, whatever it is that we can do to help to get them to the next step. We want to do that as well, and it's not just us. Other good startup lawyers do the same thing. So it goes back to find someone who fits what you need and has experience in, doesn't have to be your particular industry necessarily, but the type of company you are and where you're headed. Find the right fit and find someone that you feel good talking about.
Right on. Appreciate it. Okay. Let me double check, see if I missed any final questions. But I think we're good. Yeah, and we're coming up on time. So Ryan, is there anything you'd like to share with the community? You can feel free to let people know if you got any fun straddling, news or events. Yeah, what have you got? Let's hear it, man.
Sounds great. No, I mean, I guess I would just wrap up by saying, people should feel free to reach out to me anytime with questions. Don't be afraid to, shoot me an email or message or give me a call. To that last point, I'm always happy to help. And if it's not something I have expertise with, maybe someone else at our firm or someone I know can help with. So don't be shy doing that. And happy to be here and talk to everyone, and hopefully do hear from folks.
Fantastic. I'm going to drop your LinkedIn in the chats so people have access to it and they can follow up with you. Yeah, Ryan, you're amazing. I really, again, appreciate.
You're amazing.
Oh, well, thank you. I wasn't baiting. I was just laying out there because you're amazing. So thank you for doing this. Thank you for being a part of this. Thank you everyone for tuning in and asking some really wonderful questions that were insightful and helpful for everyone in the community. Ryan, I'll see you on Friday. Or that's tomorrow. I'll see you tomorrow, man. All right.
All right. See you
all right. Awesome.
Yeah, and thank you, Gary, for making this all happen and supporting the community. It's amazing everything you do.
Appreciate it. Yeah, more fuel to keep it going. All right. With that, take care, everyone. Have a fun weekend. All right.